Hi, Quarz is a fellow unit holder of Mapletree North Asia Commercial Trust. It is in all MNACT unit holders' best interest to vote against the current value-destructive proposal to merge MNACT with Mapletree Commercial Trust.
Here's the background. In December 2021, MCT proposed to merge with MNACT in a scrip and scrip plus cash offer. With MCT unit price correcting in line with its low dividend yield peers to 1.83 Singapore dollar, the implied proposed offer for MNACT is 1.1 Singapore dollar. This offer is at a substantial discount of about 11% to MNACT's latest NAV of 1.23 Singapore dollar. MCT's offer for MNACT is the worst and at the highest discount to NAV in the 20-year history of SGX REITs. In all these transactions, the REITs have traded below NAV before the offer. However, the transactions took place either at NAV or at a premium to NAV. All the assets purchased in the last 4 years were from Mapletree and third parties. More than 25% of MNACT's portfolio was purchased near NAV. It is ludicrous that the manager is now recommending unit holders to sell the assets at a discount of more than 11% to a related party. Shouldn't this trigger a corporate governance review? MNACT unit holders will also suffer a sizable drop in dividend per unit of about 9% and a drop in NAV of 11% in the proposed offer. Despite the inferior offer, it is puzzling why MNACT have chosen not to conduct a robust sale process to protect unit holders' interest, but to only negotiate with MCT, a related party. Would MNACT have recommended a similar inferior offer to sell the REIT at 1.10 Singapore dollar per unit to a third party and not to MCT, which is a related party? If not, isn't this a potential breach of fiduciary duty? In a similar recent merger proposal, which was above NAV and DPU and NAV accretive, proxy advisors Glass Lewis and ISS recommended to vote against the merger due to the lack of a robust sale process and the failure to consider better alternatives. In contrast, the offer for MNACT is substantially below NAV and unit holders will suffer both a loss in NAV and in DPU. The inferior offer also does not consider the key catalysts which can drive MNACT's unit price potentially back to pre-COVID levels of 1.2 Singapore dollar. Festival Walk is Hong Kong's equivalent to Singapore's Vivo City. The mall is next to one of Hong Kong's busiest MTR stations. It is also situated in an area with a high student and resident population of 350,000 within a 1-kilometer radius. Also, we expect rental reversion to be positive. The current rental reversion is negative because the last batch of rental contracts were renewed right before the 2019 Hong Kong riots when rents were still high. Most of the contracts have already been renewed in 2020 and 2021 at much lower rates during the riots and during COVID-19. With the reopening following the lockdown, we expect rental rates at Festival Walk to climb. The Hong Kong government has given every resident $1,300 in consumption voucher, equivalent to 20% of Hong Kong retail sales in 2021. With the reopening of the Hong Kong-China border, a 10% rebound in Festival Walk's rental income can drive MNACT's dividend yield to 6.7%, making MNACT the highest yielding REIT in Singapore with a market cap of more than 3 billion Singapore dollars.
We call on all MNACT unit holders to protect their interests and vote against the current value-destructive merger proposal. Thank you for your interest. We'll provide more updates on MNACT. Please register at our campaign website, bettermnact.com. Thank you.